The following program is being brought to you on the Voice America Business Channel. For more information about our network and to check our additional show hosts and topics of interest, please visit voiceamericabusiness.com. The Voice America Talk Radio Network is the worldwide leader in live Internet talk radio. Visit voiceamerica.com. The views and ideas expressed on the following program are strictly those of the host or guests and do not necessarily reflect the views and ideas held by the Voice America Talk Radio Network, its staff, and management.
The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Whites, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. This is the In Black and Whites radio show. Hey, I want to thank Rich Avanzino last week for coming on the show, the CEO of Maddie's Fund. We had a tremendous outpouring of kind words and gracious amount of interest, and I really appreciate that. For all you pet lovers out there, it was certainly a great show. This week, we're going to do something a little bit different. I promised you several months ago, back in January, we came out with our top 10 investment themes for 2014, and today we're going to grade ourselves. And I have brought back onto the show with me managing partner of Fusion Analytics Investment Partners, Kevin Lane, and Kevin's going to give us an idea of where the markets are, particularly in relation to the investment options, the themes that we came up with for the year. But before we do that, a couple of housekeeping issues. Feel free to email us at peter@inblackandwhites.com if you have any questions for Kevin. I'll also be tweeting some interesting notes that Kevin comes across, if he actually has any interesting notes, right, Kevin? Throughout the show. But you can also dial into the show. They gave you the number, but it's 866-472-5790. So with that, I want to welcome back to the show Kevin Lane. For those that don't know, and I've said it many times on the show, Kevin's been ranked by Business Week magazine as one of the best stock pickers in America. And he uses some serious mathematical and statistical analysis that allow him to pick stocks. In fact, several months ago, we had a show where Kevin actually discussed how he comes up with the information and how he analyzes information to determine whether a stock is a good buy or not. Well, back in January, we said we're going to give you all the top 10 investment themes for the year, and I think that now it's time for us to say how we're doing as we finish the first quarter. We're kind of getting into the summer solstice, and people are starting to think about summer vacation, what should they do, and so forth. So we're going to recap the top 10 themes, and Kevin's going to opine on what he thinks happened with those themes and where the market's going. So Kevin, welcome back to the program.
Thanks, Peter. Appreciate you having me.
No problem. So the first comment that we had was that the economy growth is going to pick up, and we're going to estimate that GDP is going to be in the 3% range. And then we made comments about there'd be a continued housing construction recovery, an energy boom, and U.S. gaining its share of global manufacturing. I graded us a B in that regard. Give me your thoughts.
Yeah, I think that's pretty accurate. I mean, excuse me, the economy has clearly been on that sort of post-financial crisis, which now is a longer time ago than it seems like. It seems like it wasn't that long ago, but we're many years past the '08 financial crisis. But the economy is still suffering from what happened during that crisis. But clearly, there's been a continued recovery. So I think in that vein, I think we probably were closer to an A maybe. The energy boom, I think that's been accurate, and that's probably a much longer term secular story. That's probably a story that goes on for a longer time. The stocks will have ebbs and flows, of course. They'll have, their corrections along the way, but the idea of, this sort of, U.S. Energy cycle and this boom, I think, will continue for a longer time. So I think you're right on that as well. I think overall we're probably looking at a B. Gaining global market manufacturing share. There's true that we're starting to see the jobs come back because the technology is being introduced into the workforce, here in the United States more so than, probably at any other rate in the past. So I think, we're definitely gaining global manufacturing share, but I don't necessarily know if it's adding as many jobs as it should right now because it's really a robotics sort of revolution in manufacturing that's offsetting the cheap cost of emerging market labor. But I agree overall we're probably about a solid B there.
S&P sort of had a kind of a little slow start to the year, and I guess I almost want to ask this question, Kevin. Where do you think the markets are in their cycle at the moment? From a macro level.
Yeah, sure. We've done a lot of writing on this recently. I know you've had a lot on your blog, as well as the firm corporate blog as well. And markets are interesting in that when the headline news is its worst, even though it's the scariest, you want to be buying because at that point, it's already been discounted, all the bad news, and now people are saying can't get any worse. And people are always perplexed. Investors, particularly novice investors, are always perplexed that the market could embark on a big rally when they're reading the newspaper every day and the headlines are horrible. Conversely, if you go to a market cycle top, headlines are usually really good because the market's been rallying for a long time, but the market anticipated the rally, anticipated the recovery, so it started, ahead of it. Therefore, it also starts to top typically before, the positive news cycle tops. Again, it sounds perverse and it sounds backwards, but the market doesn't look at today, it looks forward. And what we've been seeing of late, we've had a tremendous run over the last 18 months or so, and then if you want to go back to the 09 lows, we've had an even bigger run, of course. And I think the market's definitely a bit ahead of itself here. We haven't had a 15 to 20% correction now since the summer of 2011. So it's long in the tooth, even looking at average amount of time between sizable corrections. Let's say the average is, 400 and some odd days or thereabouts. We're at 450 days or thereabouts. I forget what the exact number is without a correction of greater than 10%. So I think we're due there. And the interesting thing, if you look at S&P earnings right now, there are about 241 companies that have reported earnings on the S&P so far for this quarter. 70% of those companies have beat analyst expectations. Yet if you look at what the stock prices have done after they reported these positive expectations, the vast majority of those companies have actually gone down. So they've reported good earnings, which, again, a novice investor would say, well, they reported good earnings. Why did the stock go down? And I think that's because the market is actually discounted that this may be close to a peak in the profit cycle. So we're definitely a little more cautious than we've been now over the last, say, 2 or 3 years on where the market may be heading.
That's interesting, that especially that last point about how earnings have exceeded expectations, but yet you're cautious about the market.
Well, right, and we always have this saying. It says, it's not the news that matters; it's the market's reaction to the news. If you have an exogenous event or a political upheaval somewhere and the headline news is horrible and the market goes up, that's all that matters. It's the market's reaction to the news, not the news. And in this particular, so that's why for me, given we've had a huge run in the last 12 months, given we've had up 180 some odd percent from the 09 lows, to see positive earnings and then have the companies go down, and not just one or two, but outside of Apple, the vast majority of companies that have reported positive earnings have seen their stock price go down 1, 2, 3, 4, 5 days after the earnings report. Suggests to me that maybe a lot of the good news is baked into the cake already.
Yeah, that's interesting. So the second comment, the second theme that we came up with for the year was fixed income. And we estimated there'd be a continuing rise in interest rates, particularly on the 10-year Treasury. And it looks, 10-year Treasury's up, 4.3% year to date.
Yeah, well, I mean, clearly, 10-year Treasuries had spiked a bit on our last call. We were, approaching like 3.1 or 3.2%. They've kind of backed off a little. I think clearly there's going to be inflation at some point down the road. I mean, we're seeing it in food prices. Energy is still generally high, the prices at the pump, which we're expecting over time with the secular energy boom to moderate, but that hasn't happened, of course, yet. It'll take, a while for all this, domestic energy to really get into the economy and affect the prices at the pump. But generally speaking, rates are kind of, still in a neutral phase. I mean, they haven't broken any lower. They haven't really gotten back into the lower threes. So, the jury's out on that one. I think if we were going to give ourselves a grade at this point on interest rates rising, we're probably, in the C to C plus category because it's, they've moderated a bit in the last 6 months. But, I think the ultimate, goal obviously is, to be accurate in your portfolio and your risk management, not necessarily, forecasting. Ned Davis, who, had written a great book at one point, and it was called, Being Right or Making Money. And the point was, who cares if you're right on your forecast, but if you don't monetize it. So obviously the end game is to be right in terms of where your portfolio is aligned and make money relative to the prediction, if you will. But in that one, I think we're probably looking at a C plus there.
Yeah, and the other quick comment on that too is, what's your take on munis, high yield munis versus, say, AAA rated corporates?
Well, I mean, generally speaking, clearly you're going to have risk in high yield instruments, versus AAA corporates. So, I mean, at this juncture, and then, there's the worries about things that happened. I know you discussed in depth on your program about what happened in Detroit and things of that nature. So until the U.S. economy and the debt picture gets a little clearer, I think high yield munis clearly are going to, be suspect. You're going to have to be really selective on where you buy your high yield munis and really examine at the state level how the local, and the state economies are doing in that particular state, because of things like that happened in Detroit.
And I would agree with that. Yeah. So fixed income's kind of as a recap, sort of a space where we're not quite sure really what to make of it yet. We're kind of in the middle but do you still feel that it would be a decent investment theme for the remainder of the year?
Yeah, I mean, if you're looking for yield, clearly, after interest rates going, everything is cyclical in this world. We always talk about it, even jokingly in the fashion world that everything, fashions recycle themselves. And, the same is true for the markets. And, we've had a 25 plus year long-term secular down cycle in interest rates. Eventually that's going to change. Cycles always come back. So I think there's a greater degree of likelihood after 25 years of interest rates going down that interest rates, will eventually, start to rise.
And that's interesting. Kevin, we're going to take a quick break. When we get back, we're going to continue talking about our top 10 investment themes and our grades on how we've done so far year to date. You're listening to the In Black and White's radio program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. I am your host, Peter Weitz. We're joined today by Kevin Lane, managing partner at Fusion Analytics. And Kevin and I have been talking about recapping our top 10 investment themes for 2014. Before the break, we talked a little bit about the economy and we talked about fixed income. Kevin, now let's talk about the U.S. stock market. I mean, obviously, people are walking around going, oh, stocks are so high. What am I going to do? What do you think about valuations and where the market is at the moment?
Yeah, well, I think from a valuation perspective, a lot of people, will argue this sort of back and forth, and everybody uses sort of different valuation metrics. I think out of all the factors that, could affect stocks, I think valuation is the one that's, the least problem with most analysts or, most investment strategists. Valuations, they're not cheap by any stretch of the imagination, but they're certainly not stretched. I think people would say they're a little above fair value, but the market has historically been able to have stretched valuations for quite some time. So, I think the valuation issue isn't really as much of an issue at this point right now for stocks, even though I think the market is likely to correct, going forward here as we enter, the seasonal period of May to October. There's an old saying on Wall Street, sell in May and go away, which is a reference to over 60 years of history. If you've been out of the market for May through October, you've done a lot better than had you stayed invested during those periods of time.
The stock market for a grade. I don't know how you felt about that, Kev, but we're a little more cautious than I think the markets have actually supported.
I think, again, and this is why we talked about earlier, in theory versus reality. However, as you know, in sort of some of the strategies we manage in-house, while we may have been cautious, we did respect the trends in the market and stay invested pretty fully right up until not too long ago. And recently we've been sort of changing our asset allocation posture in terms of invested level to cash. So, and we always have this, saying we talk about, you can have strong opinions, but you have to hold them loosely. Meaning, if you have a strong opinion, you can't let that get you off track of what the market is doing. If you say you're bearish, but the market keeps going up and up, and you have all these great reasons you cite you're bearish, but the market continues to go up, you're doing yourself a disservice. So I guess while we may have maybe not graded out as well on the prediction in terms of, staying invested and letting the market dictate when we should change our allocation. I think we did a better job where it counts than versus the prediction, if you will.
And where are you invested right now in terms of percentages, long and short and cash?
I don't know the exact number. We haven't run those reports yet, but I know we have raised a significant amount of cash, probably close to 30%. Possibly may do more as we start to see things unfold. There's been a significant shift, and we should talk about this as well. There's categories within the market called risk on and risk off, and the risk on classes are more things like growth stocks, cyclicals, high technology, higher beta, things that are juicier, that move more than the market does. So for a long time, growth, high beta, technology, biotech, those outperformed, for the last couple of years pretty handily. And only recently now, in small caps in particular, only recently we started to see that risk-off trade unwind, and now you're seeing value, large cap, and and other areas of the market start to come forward, and so that risk-off trade is starting to be what's working. So in other words, if I was running, if I were a listener to the show and I looked at my portfolio and I was holding, hypothetically, a lot of tech stocks, a lot of biotech, or a lot of small cap, I'd really start to think about realigning my portfolio to start holding a lot more larger cap stocks, value stocks, lower beta. And for maybe the listeners that are novice, let me explain lower versus higher beta. High beta means that, so let's say the S&P moves, 2% on a given day. And 1 would be an equal beta, meaning the S&P is considered a 1 beta. So a higher beta stock, let's say like 2 beta, will move 2 times what the market does. So if the S&P were to rise and fall by 2 points, 2 percentage points, the higher beta stock would rise and fall by double that. And a below beta stock, a lower beta stock, would be something that moves a little less on the upside and the downside than the overall market or the S&P. And so I think low beta is being favored right now. So from a portfolio construction right now, I think the sweet spot in the market is larger cap, value stocks, and lower beta.
That's interesting. Next one we talked about was Europe, and we felt that the European market sort of lagged behind the U.S. market in its recovery from their, I want to say, depression. But it's been a little slow to sort of start making a move. How do you feel about that as a sector?
Well, that's fairly, that's, I think, accurate. And I think, what's happened is, as bad of a mess the U.S. was in during the financial crisis, Europe was in a much greater mess. Therefore, the fact that that's lagged is not necessarily surprising, that Europe has lagged the U.S. in terms of its recovery, in terms of its stock market. And Europe is different than, our economy, which is one big economy. You're talking about, there's a lot of strong engines in Europe, meaning like Germany, which has a much more solid economy. Then you've got, countries like Greece or Italy that are more tourist-based, less of a diverse economy, and they've struggled even more to get back on track. So I think when you look at Europe, you have to look at Europe as within subsectors and say, well, some of Europe's done even better and closer to maybe what we've done here in terms of economic recovery and in terms of market appreciation of their stock market, and then other segments of the European market have done, much worse. So I think it's really been bifurcated over there.
Yeah, so I gave us a solid C on Europe for the moment.
Okay, I'll begrudgingly agree with that.
Okay, fine. The next one we talked about was precious metals, and it was really interesting because it's been hammered as a sector the last year, 18 months, and so many people had really bet heavily on gold. But as you've said many times, and as we agree, when there's blood in the streets, that's when you got to start looking to buy something. And we started to consider taking a position in the precious metal sector. How do you still feel about that as an investment option?
Well, if you look at, there's obviously lots of different segments of the precious metals, but, you mentioned gold, so we can start there. Gold had this secular run for like 8 or 9 years. I mean, gold technically started really its advance in 2002, right up until about late 2013, and of course, it got into that trade where all of a sudden in 2013, it was very akin to what happened in the internet bubble, in that large sections of the population watched technology stocks during the internet bubble, didn't participate. And then little by little more came to the party. Ultimately, the last guys came to the party, and then when there was nobody left to buy them because everybody that wanted to buy them had already owned them and pushed them to the stratosphere, it unraveled and did itself in. And that happened with gold for a long time. There were early adopters of the gold trade, and then more people started coming along each successive year. And towards the peak in 2013, it just became oversaturated. Everybody was in on the gold trade, and everybody had to own gold. And, that perfect scenario that we talked about where it doesn't make sense, when you read all of the headline news, gold was at 1,700, but people were calling for 5,000 an ounce. This is why. This is happening, debt situation, problems in Europe, Greece, blah, blah, blah. And so reading it from a rational perspective, if you don't understand how markets really work, you'd say, man, I got to get into this gold trade. And it completely was a point where everybody bought gold. There was nobody left to buy. So then once the selling, it's like yelling fire in a crowded movie theater. When everybody's all in, and then the fire starts and somebody yells fire, and they all try to stampede, and there's nobody left to buy, you had that plummeting in gold. So, I think at this juncture, we're looking at gold as, if your horizon, and I think we talked about this in January when we did this call, if your horizon is to, buy gold for a trade, had you bought it in January and held it for a while, it did really well for a trade. But by and large, it's not really going anywhere, on a new multi-year, uptrend, if you will, or just continuing to rise. And I think that's going to be the way it's going to be for a while. When you have something collapse like that, there's a long period of sort of staying out of favor. So I think there'll be opportunities to make a trade in gold where, it can rise 15 or 20%, then it sells off. But generally speaking, as a core hold in an asset allocation, we're kind of still avoiding that sector, if you will.
And as a sector as a whole, and we hear a lot, though, about silver. I'm wondering what your take is on the silver market.
It's interesting in that most asset classes and then the sort of subdivisions of those asset classes, they sort of all trend in similar directions. Some will do relatively better, relatively worse. But if the whole precious metals sector or the is in a bull market or a bear market, it's very rare you could have precious metals in a bear market and hypothetically silver just race to the races, because the macroeconomic factors that are factoring the whole precious metal sector affect every base metal within that. So in other words, some may do relatively better than others, but if precious metals have all these negative influences suppressing them at this point, it's usually something, those macro influences are going to affect every sector within precious metals. So I would think at this point, silver's in that same boat, meaning I think there'll be trading opportunities in it. But to say you're going to buy and hold silver right now probably isn't, the best thing to do, in my opinion.
Yeah, so stay out of that sector
unless you're a trader. Yeah.
Interesting. Kevin, we're going to take a quick break. When we get back, we'll finish up, and then I might ask you a couple of questions about some individual stocks, and I want to talk a little bit about technology. But we're going to take a quick break. You're listening to the In Black and Whites program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. I'm your host, Peter Weitz. You're listening to the In Black and Whites radio program on Voice America, and we are joined today by Kevin Lane, managing partner of Fusion Analytics, and we're talking about investments in the market. And back in January, we came up with some investment themes for the year, our top 10 investment themes, and we're kind of going through them as a recap to see how we did. Overall, I think we did pretty good. Some were kind of lagging a little bit, but we still feel pretty strongly about them. So prior to the break, we were talking about precious metals, but I want to focus a little more, Kevin, on a couple other things. Muni bonds, for example. We touched on it earlier in the show, but I kind of feel like its beauty is in the eye of the beholder kind of mentality. And I'm wondering what you think about that.
Yeah, I mean, I think you're right in that regard. And reviewing the list, we talked about, how in 2013 Detroit and Puerto Rico and the defaults and things of that nature scared the market. And I agree, it's beauty in the eye of the beholder. And we were briefly talking about it when we were talking about one of the other segments. We had talked about earlier. We kind of hit munis for a second, and going back to that, I think it's really a case by case basis. You really, particularly if you're buying munis that are in areas that have done worse, like California munis probably, you have to be very selective there because California was, hit pretty hard by the crisis and has, different debt structures and things like that are going on in that state versus Chicago, for instance. If you're looking at Illinois, as a potential place for, some municipals, but the city of Chicago, if you want to then break it down from the state level to the city level and things of that nature, Chicago's another area that's been hit hard, and maybe the risk of potential default is much greater there. So I think you're right. The beauty is in the eye of the beholder, and you really have to, be selective and do your homework on, where you're investing in the muni market to make sure the risk of default, you can minimize that a little.
And the next one kind of has really been my favorite pick for the year, and it has been for a while, and that's energy. The energy sector just got hammered last year, and I just from a just macro level, I just couldn't understand why. But I think this year it's recovering pretty well.
Yeah, the energy market. We've talked about that secular theme with all the natural gas plays and the shales and the various things going on here domestically that, ultimately, in my opinion, become a massive stimulus for the U.S. economy as eventually energy prices become lower, if people start, to be able to heat their home for less, be able to put gas in their gas tank for a lot less, and I'm talking, next year, the year after, 5 years from now, that becomes additional discretionary income. And since 2/3 of all economic activity, in our free market economy is driven by consumer spending, the ability to, put more money in people's pockets vis-a-vis energy efficiency is certainly only going to help the economy going forward. The only caveat I would say to that, and like I said, I think the energy sector is a long-term play, but within longer-term plays, you do get boom and bust cycles, meaning, you could catch the energy trade right in 1 year, and then, you buy them the next year, and there's a 20% correction, albeit they may be on their way to going up 200% over 10 years, but if you buy them or enter them at the wrong time, sometimes it can be a little painful to own that. And the other caveat I would talk about that, if you look at market cycles of what stocks and industry groups work, during a bull market, during the rally up, during a bear market, energy by and large is what typically would be called a late economic cycle play. Meaning energy tends to actually be one of the last groups to rally right before you enter into, an economic soft patch or a recession or a bear market for stocks. So in one breath, while energy has been a place that would reward you or has rewarded you over the last, 6 months, 12 months, what have you, it also tends to be a late cycle industry play. So that's got me a little bit cautious as well as looking at, when are we going to have, a good correction again? And a lot of times people hear that word, and because we're not far removed from the financial crisis, when you say correction now, people think that every correction is going to be like, oh, wait, we're going to go down 45, 50%. That's not necessarily, true. We could go down 15 or 20%, which a situation like the financial crisis is a normal bear market correction. But it can be painful, 15 or 20%, particularly if your portfolio is higher beta in nature and moves more than the market. We could have a 15% correction in the S&P, but your portfolio could have a 30% correction. So it's really important to look at the constituency makeup of your portfolio, particularly at inflection points like potential bottoms and tops. And energy as a late cycle play, has me another reason in the con column potentially here.
Interesting. Next, we talked about commercial construction, and we felt the commercial sector had not yet recovered from the recession of 2008, but yet we're just starting to see that happen now, particularly when you get into cement and steel and industries like that. How do you think we've done in the commercial construction sector?
It's not something, I follow on a regular basis, versus, let's say, retail constructions and home starts, from a single-family home perspective and residential. But, by and large, both of those markets have kind of tracked together. And, we have had a recovery. Granted, if you were to pull up a price chart at, new home sales when they peaked in, 07 or 06 versus where they are now, it doesn't look like a recovery at all, of course. But if you look at, from where we were in 08 to present, it's certainly been a good recovery. But, there's certainly a long way to go in both areas. But clearly that's a major part of the U.S. economy, so we need that to be healthy, to have the market and the economy to continue to be healthy. So I think you're going to still continue to see an improvement in residential and commercial, maybe with some seasonal fluctuations that are normal for that industry. However, I think it's still going to be a modest, gradual improvement.
And correct me if I'm wrong, but it seems to me that sector. I probably am. Yeah. All right, we can move on. I think that sector seems to lag because a lot of the residential builders, don't they report earnings sort of after a project they're building sells out, which is probably several months or a year behind when they actually started, and that could potentially offset some future earnings?
True. In terms of revenue recognition and reporting, that's absolutely true. But I think that's why people, you try to look ahead of the channel. So I think that's why people put a lot of emphasis on, applications for new building permits, which will, so building permits are rising and things of that nature. That's sort of a leading indicator of where building trends are going and ultimately then earnings. So I think while that's true, I think that's why people look at sort of, permits and new housing starts sort of as a way to look ahead.
Interesting. Next we talked about, let me back up. So I think in that sector, we did okay by picking it, but it sounds like it's kind of another one we just want to stay in the game for a little while longer.
Yeah, I mean, the housing stocks actually did quite well, and they were one of the first segments of the market to rally off the post-financial crisis lows. But right now, the housing stocks have actually really underperformed the rest of the market, like the banks and different areas of the stock market for a while, and are actually starting to break down a bit. So, at this juncture, I'm a little negative on the housing stocks, at least for the intermediate term.
Okay, we got three to go, and I think there are three interesting sectors that we've seen a lot of activity on. The first one, we were talking about banking, but we specifically broke it down to the investment banks as a place for value, particularly in light of the fact that there had not been a lot of IPOs, initial public offerings, over the last several years, but yet they're all starting to get back into that game. And we've since seen a pretty flurry of activity this year in IPOs, some doing okay, some doing not so well. But the banking sector seems to still be in a state of I don't know what. And I'm curious what you think about that sector.
Well, I think if you look at, IPOs, it's an interesting cycle. Again, one of the ones that kind of is backwards when you really think about, what it should do and what it should mean to the market relative to what actually happens. But typically in capital markets and investment banking and things of that nature, when you're coming out of an economic recession, people don't want to invest capital. They don't want to take risks. Venture capital, which is the initial seed to get these new businesses going, kind of dries up. But it's almost perverse, but, it's taken from 08 to present, to 2014 for the IPO market, the venture capital market, the initial public offering market to really heat up. So, you're 180 some odd percent up in the S&P 500, and now all of a sudden everybody's got enough confidence to start floating deals and things of that nature. So if you look at it, spikes in public offerings and things of that nature tend to occur again towards the top of a market cycle. So although it sounds perverse, you're saying, oh, this is great, a lot of money is being raised for IPOs and things of that nature. It really tends to coincide closer to a top than anything else.
Interesting. So that's something that we want our listeners to pay close attention to. Basically, you're saying that the more IPOs that are out there and the more money being floated to take companies public, the more it appears the markets have peaked.
Yeah, and the other part of that equation is looking at what is the average deal doing, meaning what is the return on the first day of an average deal, and they start to, when people start to get giddy or a little overconfident, they start bidding them up. And then what are the quality of the companies being taken public? Because obviously when you come out of an economic trough or recession, the best companies that have waited, that are good businesses that have waited to come public get pushed out first because people are most confident in those. But as things start to loosen up, as people's, overconfidence, if you will, you start seeing more and more low quality companies just being pushed to market because A, the money can be raised easier because people are more comfortable, and B, people want to push, the bankers want to push those fees out before things turn south again. So it's not just the number of IPOs coming public at any one juncture that necessarily could coincide with the top. It's also the quality of the companies coming, and when the average deal is going up $3 or $4 or 10% on a given the opening day of trading, that's one thing. But when they start going up 20 or 30%, and a lot of the deals are really getting a lot of pop lately, and you're starting to see more tertiary companies or less quality companies come public, and that's more of an issue. And this won't surprise you. Then my next comment was that, at the peak of the market in 2000, the internet bubble, that was obviously the best IPO market ever, at the top of the internet bubble.
And that's interesting. That's going to lead us into a break, and I want to get back to that internet bubble because that's one of the themes I want to talk about next.
Sure.
You're listening to the In Black and White's radio program with my host. I'm your host, Peter Weitz. We'll be back in just a minute.
Voice America Business Network, the bottom line in business.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Whites is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. I'm your host, Peter Weitz. We're joined by Kevin Lane, managing partner at Fusion Analytics. And prior to the break, we were talking about IPOs and how when IPOs, the flurry of IPO activity in the market tends to signal a market peak. And it did make me think of one company going public, in particular, the maker of the game Candy Crush. When you see, I guess, companies like that going public, anybody's getting money, and it certainly can signal that the market's out of control. But, we did talk at the break, Kevin and I, about the last time there was a big bubble in the IPO market was, I think, Kevin, back to about 2000 when this Chinese insurance company went public, and it was like the biggest IPO ever. And everybody was, dying to get in. And I think now we're almost seeing that again when Alibaba goes public, which is the Chinese version of Google. They're set to go public sometime this summer, and that could be the biggest IPO ever.
Yeah, that's an interesting point. You always have these seminal events or whatever. Also, in 2000, Amazon, Jeff Bezos was the Times Man of the Year. And literally, if you took that Time magazine cover, the date Time was, he was on the cover, and you put an X on it, on a the NASDAQ composite chart, it was literally the peak. So clearly, the Alibaba, which I guess is I think an Amazon clone,
That's right. I'm sorry. Not Google.
Yeah. So that will be interesting because it is going to come public. It is likely to be the biggest IPO in the history, of capital markets. And certainly these sort of seminal things, they happen right. It doesn't, again, it sounds perverse, but these like things that would be perceived as great events tend to happen at the peak. And, there's great charts if you look at the history of the stock market, talking about looking at the negative side. And almost at every major bottom, there's been a war or a great recession or a depression. And so the markets, again, they bottom on bad news and they top on really good news, which seems really perverse. You would think like good news is the start of better things for stocks, and bad news, is the start of worse things for stocks. But it really works the other way around. So we'll be looking for when Alibaba, gets priced and how the market reacts to that.
So that sort of under that premise, do you think that we are close to another technology burst because the technology stocks have done so well lately?
I think I think the frothiness or the bursting, happened probably in the biotechnology first. I think the biotechs were the ones that sort of maybe got ahead of themselves. The one thing, at least with the technology sector, now you're talking about different things. Certainly companies like Candy Crush, which are fads, which are, Zynga came public, had all the games on Facebook and lost 80% of its value after the IPO within like 6 months. Certainly there will be a bubble in that part of the sector. But the more traditional technology companies are going to be valued on things that, are tangible earnings, things of that nature. The one thing that's a little different, I think, about the Internet today versus the Internet in 2000, a lot of companies were going public on, you used to hear the old story that, like, you could go to Silicon Valley and have lunch with somebody and write your business plan on a napkin and come out with $20 million from a VC. Those days are clearly over, and more of the companies that are involved in Internet e-commerce and thing are actually real companies with real earnings, and the Internet is a more tangible venue to conduct business now than it was in 2000. So I think, we're not in the same spot in terms of a bubble, because when you're talking about a bubble, you're usually talking about companies that aren't worth what they should be, but yet going up in value for no reason other than the fact that they're in that space. So to your point, I think the bubble part will be the more fatty stocks, the tertiary stuff, things like, Bitcoin, which is kind of a segue, to the Internet, or like you mentioned, Candy Crush. That's not a real long-term business model. You're just a gaming company, and you're hot while you're hot until the next new game, catches everybody's fancy. So I think the bubble within technology will be within, the areas that are applicable, and it wouldn't take down the whole sector per se.
Yeah, interesting. Last thing I want to talk about real briefly, Kevin, and we're getting ready to call it a day, but healthcare. And we talked heavily about healthcare. Just comment on how you feel about that sector.
Well, it depends on whether you're asking me from an analytical standpoint or as a consumer who sees his healthcare premiums go up like 30%.
No. We're staying out of the Obamacare talk, because we'll be on the air. We'll be on the air for 24 hours straight.
Yeah, let's not talk about that. I'm waiting for $2,000 a month premium soon. So, anyways, so as far as healthcare, but it is a segue to that. In that regard, you almost can't talk about it without somehow touching on it. But premiums have gone up. The level they're probably paying out hasn't gone up that much. So the profit margins in the healthcare sector are, better than they've probably ever been. I think the problem is, however, for healthcare on a longer term basis, is the aging of the population. They're eventually going to have to pay out on more claims. There's going to be people utilizing physicians more, than in the past. So I think longer-term prognosis for the healthcare sector is probably not as good as one would think.
And I appreciate.
Let me dovetail that in two ways. Managed care, senior care, things of that, it's probably good. But as far as the HMO sector who are going to be paying on those claims, probably not as good.
Interesting. Kevin, again, as always, thanks for coming on the show. We
appreciate it.
We covered a lot of topics today, and it's kind of, I guess if I was to summarize your thoughts, is that it's still a little murky out there, and you're bullish on some things and not so bullish, or maybe even bearish on others, and so it's kind of going to be another one of those muddle through years.
When you've had the run like we've had, I always like to talk odds. If you've gone up 180% in the last 5 or 6 years, is the likelihood you have another 20% year right now? Probably not. That doesn't mean it can't happen, but the evidence is suggesting the market may be getting a little tired here.
And I appreciate that. Anyway, Kevin, again, thanks for being on the program. If anybody has any questions or comments for Kevin, please feel free to email me at peter@inblackandwhites.com, and I'll be happy to forward those on to Kevin and get back to you as soon as he answers them. Kevin, again, thanks a lot. Great show. Thanks to our sponsors, American Century Investments, Retzel and Andrus, and Stephen Douglas, and make it a great week.
Thanks, Peter.
Thank you again for tuning in to In Black and Whites. Please join your host, Peter Whites, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.